What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is September 20th of 2018. Well, folks, I hope you all are having a wonderful day today. Today, I want to spend some time to talk to you all about a specific topic that has to do with U.S. equities, and is a topic that I've gathered a lot of concern over the past few days. Now, if you happen to follow my daily updates here on the DataDash channel, or if you happen to follow me over at Twitter, I spent a lot of time rambling on about something known as stock buybacks and how they played a major role in propping up the valuation of U.S. equities. Now, to put it very simple, a stock buyback is basically where a company takes cash off of its balance sheet or borrows capital in order to acquire more of its own shares in order to create an artificial sense of demand and limit the supply of circulating shares. And we've seen over the past few years that stock buybacks have been a thing for the past few decades, but they've really become a major player in regards to the buy side of markets this past year. In fact, we've expected that there's going to be $1 trillion worth of stock buybacks this year alone, $1 trillion worth of share purchases from companies rather than actual organic investing from the buy side. So it shows that it's playing a massive role in regards to U.S. markets. The question we have to ask ourselves here is, seeing as it's becoming such a large role in regards to the buy side of markets pushing prices higher, is there any period where we have to worry that these stock buybacks might not be able to play as big of a role or continue to promote prices higher? Well, there are periods of time where we have to worry about this, and it's something known as a buyback blackout period. Now, I'm not trying to scare you. That's the legitimate term that goes with these periods in the market, and it's basically defining something that has to do with a set of U.S. regulations, whereas a company cannot buy any more of its shares a month before quarterly earnings. And there's these periods where that regulatory standard comes into effect and limits a lot of companies from being able to buy back their own shares. Now, again, share buybacks don't happen at one single blip. They don't happen just like that, where some company will buy $1 billion worth of its shares. It happens over time, and they have specific people who do this and conduct this for specific companies. But seeing as 86% of the S&P 500 coming up on October 5th will not be able to go through share repurchases, this leads towards a pretty grave amount of concern. They've become a massive part of what keeps up markets at this point. And if 86% of the S&P 500, and within this 86%, we're getting companies that are large caps, mid caps, and small caps within this part of this the blackout period, we have to ask whether or not, if we miss on quarterly earnings or if some other negative catalyst comes into play, that this is also going to have a double whammy effect where not only prices generally move down from growing fears in the market, but potentially not having that extra layer of buy side activity due to a lack of stock buybacks. Now, as we go on here, it's important to remember as well that the percentage of annual repurchases of stocks from corporate buybacks tends to be quite low in October as well. In fact, this has been something that's historically shown. It's the fourth shortest month of stock buybacks that there are within U.S. equities. So we can see again, back in August, we were getting 13%, and in September, we were getting 8%. But we're going to get another 8% here on average for the stock buybacks this year. And I think it's going to be even worse this year due to the fact that 86% of companies are restricted. We'll have to see the actual numbers when they come out. Again, expectations aren't always in sync with actual stock buybacks. Sometimes the numbers come off a little bit, but we can generally tell that it's going to be on the lower end here because of the limitations on the S&P 500. So now that we've factored this in, when we talk about this, can we turn towards history and really see if this has had an effect in the past? Well, we really don't have to look that far. If we take a look back in April, for example, here, we can go down. There's a really good Bloomberg article that showed just how effective blackout periods can be on markets and spiking up volatility and bringing equity prices lower in the process. We saw a 3% dip here back during April after we had already had the crazy flash sale back in February. And this brought us back down to those lows where we could have potentially broken down lower and started a longer term correction or downtrend. So we have to be concerned about this. We have to keep this as a factor in our minds here. And again, to just emphasize how big this has played a role in markets, we have gone past 2007 and 2008 levels here with stock buybacks. Now, to be fair, this is factoring both dividends as well as stock buybacks, but this is not a combined valuation. This is each year we are seeing a general increase in stock buybacks and dividends out to company shareholders. This is really important to factor in here, guys. not only has this gone on a rampant uptrend and past the craziness of 2007 to 2008 levels, the thing to keep in mind here is that companies are spending the valuable cash that they have on hand and going into their own equities, all at the same time while we're seeing a massive amount of institutions selling out their own shares and stock options. This is a very, very concerning trend because when the stock buybacks wear off, if there's a period of time where, due to regulation in the United States or just simply by a lack of stock buybacks, if we don't have this artificial demand coming through and this starts to wear off, you're going to have a lot less buyers on the buy side, and you're going to have the same equation of sellers coming into play, if not more, over time as prices get higher. And we've already seen this. There's a lot of different indexes. You can look at the Smart Money Index. You can literally see the statistics on how hedge funds are trading at the moment. And ever since back in February, they have been on a relative depletion on their exposure to U.S. equities. So we have to keep this in mind. I think it's something more than anything that people should be watching in the stock market because it's played such a big role. And it's, I think, going to be the catalyst that's going to lead towards eventually a real collapse in the U.S. Equities market. But I'm not saying we're going to get an absolute collapse here. I'm not guaranteeing that, guys. I don't mean to, just fill you with doom and fearful thoughts or anything like that. I'm just letting you know it's very possible, and that this artificial stimulus that's been keeping up equity markets for over 10 years, and in fact, I think in total has been around for just the S&P 500. We're not even talking about companies outside the S&P 500. Has been a whopping $4 trillion worth of purchases since 2008. So we have to ask here, what are some of the concerns that we have to keep in mind? Well, I'm going to say more than anything, I think you're going to get a retracement over the next few weeks in mid-October down towards the 200-day. And if you get that, if you get a break on the 200-day, which we haven't seen for quite some time until back in 2015, if we get this, this is going to be a very, very concerning sign, not to mention if we miss on corporate earnings. So the thing I tell you all to watch for here, my kind of playbook, is that I'm looking for a play on the VIX. No matter, if earnings go well or if they don't, again, there's going to be a lot of buy-side activity that isn't coming through here that would tend to be the catalyst to drive up prices. So I'm going to be looking to play on the VIX here, holding some different instruments that will benefit if the market becomes more volatile, basically major fluctuations in price and most likely a drop in price. And again, as well, guys, you got to do your own research as well if you believe that's a good play. There's a lot of great instruments out there, but you have to determine whether or not you see the same as I do. So again, don't just blindly follow me. I think that's what I'm going to be doing. I'm probably going to be playing for a play on the VIX, but also maybe something more in the long term. If we break below the 200-day, we could see some continuation of volatility in this market and could potentially start to go short on the market. That's, I think, if you get a miss on earnings for the most part, with 83% of these companies in a buyback lockout period, but along with that as well, with potentially this buyback blackout period coming into effect as well. Again, it could be a double whammy here if companies don't respond well during earnings, or if the market, even if earnings are well, don't meet expectations. So anyways, that's it for the video, everyone. Thank you all so much for watching. Again, as always, this is just one of many macro trends we got to keep an eye on in the market, and I find this stuff fascinating. I can't wait to see what happens, whether or not markets push to new highs as they have as today. We saw the S&P 500, the Dow Jones, and the NASDAQ all holding up towards their highs, if not pushing to new highs. So it's going to be fascinating to see whether or not this can have some serious ramifications. As always, thank you all so much for watching. Safe trading, stay smart, and I'll see you all in the next video. Stay tuned.